My own personal investments are in silver miners, and also GDX, which also contains about a half dozen major silver miners, by the way.
Yeah.
It's not just gold miners. It says gold miners ETF, but there's some big silvers in there. Same with XAU index, has quite a few big silver miners in it. I suspect that the juniors, SALJ, for example, will suddenly get hot a bit later. And that's usually when the let's say, they're cheapies, okay? You can buy them for 50 cents, $1, $2, that kind of thing. It's when the average Joe investor who's not been in the gold miners thought it's a bad place to be, which in fact it has not been, despite its seeming irregularities in its price movement. It's actually been better than gold, as we've measured. They'll suddenly say, I want to get in there. And they're not going to want to buy a $100 stock or a $50 Newmont or an $80 Newmont. They may go in for a handful so they can buy thousands of shares of some juniors. And frankly, I think at that point, the juniors will become hot because the big miners at that point will start buying them up. But I think it's slightly lagged to where we are right now. It would be my best guess, is that, the juniors will get hot, but probably a bit later. Now, we also measure on a spread basis, a relative performance basis, like SIL versus GDX, silver miners versus GDX.
Okay.
And they haven't quite broken out yet, but there is a spread relationship there that shows a pending breakout of pretty dynamic proportions on a relative performance basis.
Is this
what you got?
What you mean? I got SIL divided by GDX?
Yeah, and if you put that on, we look at like monthly closes instead of intramonth spikes and so forth. But anyway, there is a structure there that you can see on the spread chart, a trend structure that has been negative for SIL relative to GDX.
Yeah.
But if you notice over the last couple of years, it stopped.
Yeah.
Silver miners basically went and took out that low in 2019-20 that it made there at the 0.91% level. Do you see that sharp drop in 2020?
Oh, yeah, right here.
Over there. You got below, but you got back above it. And in other words, you're basing. And momentum of this spread says, yes, you're basing. And it won't take much firmness this month or next to break this spread out on a momentum basis versus GDX, saying, now it's time to shift over to the silver miners. And I think that's likely to happen. I'm betting personally. I'm buying some of the major silver miners.
Okay.
Anyway, that's my emphasis. We look at the dollar index as a separate, it's a major category. It's a big mover, okay, because it's also the euro and the yen. The other side of that is 70% of the dollar index. Mm-hmm. Yeah, punch that guy up there. That's the dollar index. You can see it's been in a layered decline for decades.
Yeah.
Big drops, big rallies, big drop, two big waves down since 1983. And boom, and a boom. Okay. And lower highs and lower lows. So, okay. Now, even the price has nipped out the last few years' lows. If you can focus more on that there, just the last
few years.
You can see we made lows, and after the high at 115, we collapsed down to 100 level in 23 and 24, and we kept getting buyers there. 100 level, rally, 100. It was really a non-event. In other words, you were in like a 7% range for a couple of years there. Across that. They played a price game. They tried to break out upside late last year, early this year. We said it's a bull trap. Don't trust the breakout. Sure enough, in March, which is in the middle of that range there, you'll find it 104 close in March. Yeah. Which is go over to the right.
That's October.
No, this March, 4 months ago.
Oh.
Right there, that month, we got bearish there. We said, okay, that's it, it's over. Dollar index is going down now. Major trend. Now, even price has followed through since then and broken through the price lows at 100. You had a rally back to 101 after reaching 98 a few months ago, went back to 101. Now you're back down. You even got into the, below 98 in this month. Okay. But you're below that broken structure, groping. Now, there is another level at 98.35. That's a 10-year moving average of the dollar index cash.
And I want to circle back to the broader theme of why I keep pounding on this, because we're at a point in history that's downright fascinating. You've got these multi-decade structural charts, from the dollar index to the long bond, all simultaneously hinting at reversals or major breaks. You don't often see these big tectonic plates in the global financial system moving at the same time, and it's why the next few years could look like absolute chaos from the point of view of investors who are glued to the last cycle's assumptions. Let's take the dollar index for a moment, because that's a perfect example of how misleading conventional relative strength thinking can be. When people pull up the DXY, which is heavily weighted to the euro and the yen, they get lulled into complacency. Oh look, the dollar's strong. Really? Strong against who? The euro, which is a mess of underfunded welfare states and crumbling demographics? Or the yen, with Japan's 260% debt to GDP and an aging population that makes Florida look like a college town? The dollar index is basically measuring which currency is sinking faster, not whether any of them are stable rafts in absolute terms. That's why gold keeps working. Because gold is the one benchmark that isn't another fiat liability. It's not a promise to pay from a bankrupt government or a central bank with a printing press. It's final settlement, no counterparty. And over the past decade, while the dollar index has effectively gone nowhere on net, you could draw a horizontal line from the 2015 lows right through today. Gold's up almost 4 times. Think about that. The dollar has flatlined relative to other rotten currencies, but it's collapsed relative to real money. That should tell you something very profound. Now, we've also been keeping a close eye on that spread relationship between the silver miners and the gold miners. We were talking about it earlier, the silver versus gold miners spread. On a momentum basis, this spread has been in a long basing process. It's been negative, showing underperformance of silver miners relative to gold miners. But that's starting to shift. You look at the SEL-GDX ratio chart on monthly closes. Yeah, it got crushed back in 2019 and 2020. Silver miners lagged badly. But since then, we've seen it stabilize. That's often a clue of an impending breakout. When something stops underperforming in a bear phase and then just sits there, it's building energy. It just needs a catalyst. And with silver itself showing all kinds of signs of coiling up for an explosive run, taking out major congestion levels that date all the way back to the old post-2011 bear, it stands to reason the silver miners could be set to vastly outperform gold miners in the next leg. So, that's where my personal bets are. I'm heavily positioned in silver miners, in direct silver, and yeah, I hold GDX too. Because by the way, GDX isn't just pure gold. There are some hefty silver producers in that index. Same goes for the XAU index. It says gold, but it's a blend. And I suspect when this really takes off, the big money is going to rotate into the juniors. You know how it goes. Your average investor who comes late to the party isn't going to want to buy a $100 Newmont or a $70 Agnico. They'll want to load up on something that's trading at $1 or $2 so they can say, look, I own 10,000 shares. It's a lottery ticket psychology. And historically, that's exactly how these cycles play out. First the metal moves, then the large cap miners, then the smaller cap miners, and finally the juniors go bananas when the late money pours in. That's when you see 10x, 20x moves in some little exploration stock that has a half-decent property in Nevada or Argentina. Not saying you should bet the farm on these juniors, far from it. But if you want asymmetric payoff, that's where it comes in. Just size your bets carefully. Most will go nowhere, but a few will change your life. Now let's pivot to the dollar again, because that's the hidden landmine for most investors. We've got this long structure in the DXY. Decades of lower highs, lower lows. 2 big waves down since 1985. The current multi-year chop we've seen since it peaked near 115 is just more distribution, in my view. And lately, they tried to run it back up. Tried to make a bull trap out of it. Pushed it up into the low 100s. That failed. It rolled over, and now we're threatening those big support levels down near 98. That's critical because there's a hidden momentum structure when you look at the dollar's long-term relationship to its 10-year moving average. You break through 98.35 on a monthly close, which is basically the floorboard for that oscillator. And you're talking about the last technical safety net snapping. From there, the dollar could realistically unwind back into the 70s. That's not a pie-in-the-sky guess. That's just where the next major historical support is.
It happens to be a momentum trend structure that goes back decades. When you plot an oscillator of the dollar index versus its 10-year average, you'll see there's like a multi-point uptrend that we will crack and close below if you close at 98.35 any month this year. We've traded below there. Right now we're slightly above it. end of the month. You do that, and our last floorboard comes out. And at that point, I would say the dollar is probably headed back down into the 70s. Okay, now, the question is, what does that impact the gold? Well, right now, at the current price, if you get that 98 level, you go back over to the left in 2015, where you go there, that big surge.
Yeah.
We forecasted that bull trend would get bullish in 2012, and it got up to 100. We thought it would get to 100. It did. Went ultimately higher. But in December of 2015, when gold bottomed, the dollar was where it is right now. Draw a line straight across. You're nowhere. 10 years, it's gone nowhere. Okay? Yeah. Yet gold is quadrupled. Okay, so the people that think, well, the dollar has to impact gold. Well, sometimes not. It's the ongoing overall degradation in money units, not just the dollar. And its real value degradation could be different than the dollar index. The dollar index merely measures it versus other degrading currencies. It doesn't measure the dollar versus its own money growth. Okay. But anyway, so net price to net price, I don't know that there's a great correlation. However, if you get a dynamic down move going in the dollar, that will no doubt help gold. It will be further wind at its back. It's not a pivotal thing. Again, gold is quadrupled, dollar's gone sideways. Okay. But I think a further drop here will exacerbate the situation, will also create wave effects in other markets when the dollar breaks. For example, foreign investors who own what? A lot of American stocks, more so than in history, foreign investors have come into our market. And two, foreign owners of U.S. government treasury bonds.
Yeah, the bonds.
They're affected by dollar movement too. U.S. investors like to forget the fact that the real money unit is degrading, but when they get out of their dollar-held asset and put it back in yen, or back in euros, they've had another shin kick. Not just the decline in the U.S. stock market, but the decline in the dollar. So it's a wave impactor. And I think it's about to become active.
Okay.
As a noisemaker.
Okay. So if we see the chart do that, then gold is going to do the opposite and do that.
Yeah, no, I think it'll just help gold accelerate. I don't think it's pivotal because again, gold is 3.5-fold right now versus where it was at the low in 15. So you can't say there's a great correlation. But I think a speedy move in the dollar, which I think will begin without even getting back to this month's lows, will help gold.
Look, let's pick right back up where we were. Talking about how the dollar's structural cracks are not just some finance nerd chart pattern that only matters to a few old-school commodity guys. These cracks are visible from Main Street to Beijing, from small-cap credit spreads all the way to how the average family is scraping by with multiple maxed-out credit cards. And we were saying how this multi-decade horizontal pattern on the dollar index is basically one big sign that its purchasing power versus real assets is evaporating, even if it tries to look strong versus the euro or yen. Meanwhile, gold is quietly telling the truth, tripling or quadrupling in price since 2015, while the dollar's been stagnant versus other flawed currencies. Now here's something that I think most people underestimate. The real psychological inflection point is always lagging. Everyone waits to see it confirmed in prices and headlines before they believe it. By the time CNBC is running specials on the gold rush of 2026 or whatever, the opportunity will already have largely passed for patient, prepared investors. Think back to the 1970s, when gold finally blew off to $850 an ounce in January 1980. The general public piled in, literally lined up outside coin dealers. But gold had already done a 20 times from the $35 Bretton Woods peg that Nixon nuked. The real asymmetric gains went to the people who bought in the early 70s, when everyone said, "Why bother? The dollar's king. Gold's a relic." Sound familiar? Today we have central bankers openly buying gold, countries like China hoarding it 10 times faster than they admit, 40-plus nations repatriating their reserves from New York and London. And yet you still have the average talking head saying gold is irrelevant in a modern economy, or that Bitcoin is the new gold. As if something that can be vaporized by a hard fork or a regulatory ban is the same as a chunk of metal that survived every empire collapse for 5,000 years. Now, since you brought up silver, let's dive a bit deeper into that, because the technicals there are flat out explosive. You look at the long monthly charts on silver, you see that congestion range from about 2020 to early 2024, with repeated hits at $27 to $28 failing to get through. That was the market coiling. It finally punched through, and now we're in the next leg higher. This is classic breakout structure, and the momentum underneath suggests this is only phase one. If you overlay historical analogs, for example, the 1977 to 1979 period, you'll see a similar multi-year sideways that resolved upward with a vengeance. From there, silver went from roughly $6 to $50 in under 24 months. Today's equivalent move would imply silver leaping from the recent 24 to 25 base up to 200 or so. Not necessarily in a straight line, but certainly within the realm of plausible if the dollar accelerates its decline. And look, I don't say that lightly. I've got friends in the industry, smart, fundamentally rigorous people, who fully expect $200 silver at some point in this cycle. I wouldn't be shocked. Wouldn't be shocked at all. So that's why most of my own personal positioning is heavily in silver, silver miners, and ETFs like GDX, which ironically also have some big silver players mixed in. The juniors? They're going to be nuclear eventually, but typically they lag slightly until the crowd arrives. Then suddenly every newsletter writer in North America is putting out top 10 junior silver rockets lists, and that's when the melt-up happens. You'll see 30-cent stocks trade at $5. Happens every commodity cycle. I want to reinforce something here because it matters for how you prepare. Gold and silver bull markets, the real secular ones, are psychologically different from stock bull markets. If you make a killing in tech stocks, you sell a piece, you buy a Tesla, you upgrade your kitchen. It's about lifestyle enhancement. But when people pile into gold and silver, it's not about upgrading their countertops. It's about survival instincts. When the price is rocketing, the last thing most holders want to do is convert back into the very currency they no longer trust. That's why you hear the old saying, there's no bull market like a gold bull market. Because there's very little secondary supply that comes loose when prices rise. In fact, it often gets tighter. That's also why I keep hammering that availability, not price, is ultimately going to define this market. You look at the physical ecosystem. 6 primary mints on the planet: US, Canada, Australia, South Africa, Austria, UK. A handful of major refiners. That's it. This is a just-in-time industry. If there's a mad scramble, you think these mints are going to keep happily shipping monster boxes to US coin dealers while their own citizens panic? Not a chance. When the public finally gets the memo, physical will disappear from shelves in days, not weeks. And you're already seeing hints of that from the top of the pyramid. As I said before, more than 40 countries have physically repatriated gold reserves from the Fed and the Bank of England. That's stunning. Those were considered the absolute safest places on Earth for decades. Instant liquidity, top legal protections, and they still said, nah, we'll take it home. They'd rather deal with the inconvenience of local vaults than trust paper promises in a weaponized global system. That is not normal. That is a flashing warning light. Meanwhile, let's talk about these bond markets, because they are the real systemic risk right now. Everyone's watching equities. Sure, Nasdaq's bubbly, S&P valuations are extreme, but it's the sovereign debt markets that matter most. You break trust there, and everything else follows. We've seen a generational collapse already in long bonds. From the 2020 peak to late 2022, T-bonds lost over 30%. That's catastrophic by bond standards. And since then, it's just been sideways chop in a death zone. Yields elevated, prices stuck. That's not healthy basing. That's exhaustion. And as we've said, there's close to $1 trillion worth of corporate debt coming up for refinancing this year and next, much of it at double or triple the old interest rates. This is going to pinch earnings, blow up business models that only made sense at 2% capital, and start the next wave of downgrades and defaults. Commercial real estate is the canary already keeling over, and that's tied directly to local banks' balance sheets. That's how you get systemic stress that forces the Fed to pivot, whether they want to or not. And look, they will pivot. They always do. Powell can bluster all he likes. When push comes to shove and markets start to break, they slash rates, they launch new facilities, they print. They have to. The alternative is letting the entire debt superstructure collapse. That's political suicide. So every time you hear tough talk, remember that the Fed has never let a true deflationary cascade run its course. Not once since the 1930s. That's why gold and silver don't care about short-term CPI games. The CPI is a circus mirror. Shadow Stats, run by John Williams, still pegs real inflation closer to 10% or more. You look at rents, insurance, groceries, all screaming higher. But the BLS massages it into 3.2% inflation. Sure, if you only eat marshmallows and ride a bicycle. That's why I always joke it's not the CPI, it's the CP lie from the BS. So investors who think we're suddenly going to get tight money forever are deluding themselves. The next big leg of QE, and it's coming, whether triggered by a stock collapse or a treasury funding crisis, is going to be larger and less restrained than any before. Because this time it will come, despite inflation still being above target. That's something that's never happened in the post-Volcker era. The Fed's always had cover from low CPI to justify easing. Not this time. This time they'll be easing into high CPI. That's how you break trust. That's when the dollar structurally cracks, not just versus other fiat, but versus goods and services. And what do you think gold does in that environment? Or silver, which has vastly more ground to make up? This is why my base case is still silver in the $60 to $70 range within this next surge. Not the final top, just the next milestone. Could it be $200 at the blow-off end? Easily. In fact, adjusted for the real dollar erosion since the 1980 $50 spike, silver should already be near $200 to match that high in purchasing power terms. Meanwhile, gold at $5,000 is the obvious roadmap once this monetary regime truly stumbles. And with sovereigns, central banks, and even populist movements all grasping for monetary anchors again, it's not far-fetched. You've got BRICS pushing gold settlement concepts, African states calling for commodity-backed currency frameworks, even voices in Washington dusting off gold-linked bond proposals for credibility. And by the way, don't underestimate how fast public psychology flips. When the average investor realizes gold is outperforming stocks, not for a month, but for multi-year stretches, that's when you see mass flow. And by then, it's too late to buy physical without paying nosebleed premiums, if you can get it at all. One last story for context. I remember back in the early 2000s, after the dot-com crash, it took years for people to trust gold again. Then suddenly, around 2005, it was like someone flipped a switch. The juniors went from penny flotsam to $5 rockets almost overnight. And you know what most of the crowd said in 2004? Gold at $450 is overpriced. It'll come back down. They said the same at $900, the same at $1,500, and now they're still saying it at $3,000. Same with silver, same with miners. Markets always climb the wall of disbelief, and when they finally shift to euphoria, your only regret will be how little you bought when it was boring. So look, keep it simple. For me, it's silver, silver miners, gold miners, and a sharp eye on the juniors. The dollar's next big leg down will be the spark. The Fed's inevitable return to easy money, because they have no other option, will be the fuel. And investor psychology doing its usual pendulum swing from fear to mania will be the accelerant. Stay humble, stay patient, and let this thing play out. Because history tells us that once gold and silver markets truly get going, they don't just drift higher, they run. And you want to be on board before that elevator takes off.